So hi everyone, welcome to CMI's quarterly training. I'm Carra Pewsey, the CMI's Management Training Director, and I'm excited to have you all here. This is a topic that I know has been coming up more and more and more as we've kind of seen several different and even the claims and insurance evolve and everything like that. So I'm really excited to bring in Vern Newcomb with ABI Insurance to kind of talk about the claim process and insurance in general. And so if you have questions, you can put them in the chat. I'll be watching the chat, or you can just unmute yourself and raise your hand and ask a question. Vern does have a couple of points where he'll ask if there's any questions as well, based on the topics too. And thank you all for being here. Really appreciate it. Vern, welcome.
Thank you. And thanks everyone for showing up tonight on this beautiful sunny evening to try to understand the claims process for community associations. And I also want to thank Carra Pewsey and CMI for holding these quarterly meetings to help boards understand what it takes to manage an association. So a little bit about myself. I'm a native Oregonian. I've been in the industry for 39 years now and been specializing in community associations for 22 years. And I do have a team of 9 members, again, that just specialize in servicing these accounts. So that's enough about me. Let's get into the program. So when it comes to community associations, there are 4 types of claims that we deal with typically: property damage, general liability, directors and officers, and crime and fidelity. And we'll touch base on all 4 of those. Now, property damage claims basically is the majority of the claim activity that we see with associations. And property damage claims is just that, damage to the property, whether it's common area, limited common area, or whether it's a unit. And what I'm going to do is explain how the association's policy interacts with the unit owner's policy. And I'm going to explain why it's set up that way and how it is set up that way. And there's a little factoid up here that basically says 70% of the property damage claims are from water damage. And 90% of those originate from inside of a unit. Having said that, that brings up the #1 question we get from board members when there is a claim that affects a unit and they're asked to bring in the association's policy to pay for the damage. And that question is, why is our policy paying for a unit owner's damage? So we'll get into why that's the case. So when it comes to coverage for an association, how we set the policy up on the property coverage is we refer to the governing documents. In Oregon, it's going to be the bylaws. In Washington, it's going to be the declarations. And we refer to that to see how the association's policy is going to respond to a unit. And in the association world, there's 3 types of coverages for a condominium association. We have all-inclusive, which is the most that provides the most coverage for the unit owner. That includes not only the common area, the limited common area, it covers the unit, and it also covers any improvements made to that unit by the current or past unit owner. And it could be someone who updates all of their floors to hardwood, they put in quartz countertops, sub-zero refrigerator. If it's attached, it's going to be covered under the association's policy under an insurable event. This is where I oftentimes use the analogy that you cut the roof off, turn it upside down and shake it. Cut the roof off of your unit, turn it upside down and shake it. Anything that falls out is the unit owner's responsibility. Anything that sticks, the association's policy will pay for, subject to the deductible. This represents about 90% of the associations that we insure. Most of them are all-inclusive. Another coverage form that we see is what we call original specifications. And how this is set up is the policy will cover the common elements, the limited common elements. It'll also cover the unit, but it only covers the unit as it was deeded over from the developer. So any improvements or betterments made to the unit is not going to be covered under this type of a policy. The unit owner would need to get this coverage. And then we have the bare walls policy. And this is the least amount of coverage for the association. And so how this works is the association's policy covers common area, limited common area, but it does not cover the finished interior of the unit. The unit owner would have to get that coverage themselves. And another thing to understand when it comes to an association's policy is which policy is primary. Whenever you have two policies covering the same property, there has to be one that's primary, and the association's policy is always primary. It will pay first. It will be the first one to respond to any insurable property damage, regardless of negligence, regardless of where the claim originated from or what damage it caused. So if it started from inside of a wall and affected a unit and it's above the deductible, the association's policy would respond to it. If it started inside of a unit, as we had just mentioned, most water damage claims do, again, once it exceeds that deductible, then the association's policy is going to be primary. And then down there it says, this only applies to the cost of repairs that damage exceeds the association's deductible. Anything below the deductible is typically the unit owner's responsibility. So we'll have an example of, oftentimes we're seeing these deductibles increase, as most of you are aware. Back when I started 22 years ago, we would see $1,000 deductibles. And then it went to 10,000 and everyone's like, oh, that's a big deductible. Now we're seeing 50,000 or $100,000 deductibles. So we'll use an example of a $50,000 deductible. In the event of, say, a water damage claim, we'll say a pipe failed around a toilet and did $75,000 worth of damage to a unit. It's on an all-inclusive policy. So the way that claim would be adjusted is the association's policy would pay $25,000, and then that $50,000 deductible would typically be the unit owner's responsibility. When I say typically, that's usually 99% of the associations that we see out there. So before I get into claims process, any questions on how these policies are set up and why they're set up that way? And so deductible, I had mentioned that in that example. So who pays for the deductible is determined by the governing documents. Keep in mind the deductible is another way of saying that the association is self-insuring or the unit owner is self-insuring. The association's policy does not care who pays for the deductible because they have no contractual obligation to that first $50,000 of damage. So we would refer back to the association's documents. And oftentimes the language is unclear in these documents. It may just say the association carries a deductible and it doesn't say who's responsible for it. So that's why it's very important. If your association does not have an insurance resolution, I would recommend that's the next thing you bring up at your next meeting. Very important to have an insurance resolution. And just briefly, what this does is when we go into the association's, we'll say the bylaws, it gives us a blueprint of how the association's policy is supposed to be set up and how the unit owner's coverage applies as well. But oftentimes there's a lot of ambiguity there, or it's very vague. So what a resolution does is it brings clarity in, and it becomes extremely helpful when there's a claim, especially a sizable claim with multiple units, because that resolution will specifically define who is responsible for the deductible. What if it was a negligent act? As an example, we just had a claim a couple of months ago to where a unit owner put their house plant in a sink to water it, got distracted by a phone call, left to go grocery shopping, overflowed the sink, and unfortunately, this was in a 8-story building and affected several units. However, they did have a $25,000 deductible per unit. Under that example, the association's policy would respond to any damage that exceeds that deductible, even though that unit owner was negligent on that example. And some of the resolutions do have a negligence clause in them that state that the board has the ability to deem a unit owner negligent, and that's a hard bar to pass, making sure someone is negligent. If they do deem that, then that unit owner would be responsible for the deductible or deductibles. And you could imagine if you have an 8-story building with a $25,000 per unit water damage deductible, there's going to be $25,000 for each one of those units damage. So as you can see, that it's very important to pay close attention to the insurance resolution. And oftentimes unit owners are expected to cover the association's deductible or a portion of it.
Vern,
Yes.
if there's one source of the damage, would each unit have its own claim then for the deductible?
Yeah, the way it would work, we'll say that 25,000 is the association's policy would, once each unit exceeded $25,000 of damage, then the association's policy would respond to that specific unit. And that deductible responsibility would be the unit owners. They would turn it into their HO6 carrier, unless there was negligence in that example that I explained. But typically we recommend that the unit owners turn it into their carrier, whether there's negligence or not, because then the insurance company behind the scenes can determine negligence and subrogate after any amount that was paid out on your unit. Any other questions on this? So that's how a policy is set up and why it's set up that way and how deductibles work. Now we're going to talk about the property claims process and the best practices for filing a claim. So when it comes to a claim, property claim, both parties have to be involved in this process. Even if the claim is perceived to be below the deductible from the beginning. So we have the association, we have the unit owners. And we'll start with the unit owner. Water damage occurs into their unit. First thing they need to do is to notify the association immediately. They need to contact their HO6 carrier as well. If it's a tenant, a renter, then again, the association needs to be identified immediately. And then once the association is notified of the claim, then we like to know about the claims. Even if it doesn't appear like it's going to be very big, we can note the file. In talking to us personally, we do not file a claim. We cannot file a claim until we get an instant report completed and we get permission from the property manager or the board members via email to file a claim. But by letting us know, then we can kind of help navigate the process, whether it's going to go up to the association's deductible or not. One of the biggest issues that carriers have with claims is late filing of claims. On property damage, we see some claims filed 4 to 5 months after the damage has been caused, and the carriers just get very frustrated with that because they have a contractual liability to repair any damage over the deductible. So they want to go in there as soon as possible and see what caused the loss and see if there's an opportunity to subrogate after another party. And to make sure that they have a full understanding of what the damage is and start evaluating the loss. So it's very important that claims are filed immediately. The problem nowadays is we have these high deductibles, $50,000, and it may take a while just to even determine if that claim hits that threshold. Or the other thing I discussed earlier is boards don't think that they should file a claim because it originated in a unit and that it's the unit owner's responsibility. So oftentimes that'll delay claims as well. So once the association is notified, there needs to be a point of contact for a claim. This can be a property manager, it can be a committee member, it could be a board member, but there has to be a point of contact. And this person would be the person that gathers the information from the unit owners, their insurance information, any claim information from the unit owners. The point contact also collects damage estimates from the contractors to determine, are we going to hit that $50,000 threshold or not? But that is one of the key processes in setting up a claim, is to have a contact person. And this is the number one area that we see when the train starts going off the rails, is if there's not a contact person and multiple people are involved and different pieces of information are going out to everybody. So let's go over to the unit owner. So the unit owner, needs to contact a reputable mitigation or restoration contractor. This is very important. And the owner wants to wait to start reconstruction until the association's a carrier agrees to the damage. So you file a claim, it's going to be $100,000. There's a $50,000 deductible. The carrier is going to come out and wants to investigate and get a bid on what that claim is. If the unit owner go ahead and signs up with the contractor and starts getting repairs done, that contractor, especially if it's not a vetted contractor, could overvalue the claim. And then the adjuster comes in and says, well, this claim is really only $100,000, but the contractor saying, no, it's $130,000. So it's important to get the carrier in there because they negotiate with the contractor before the work starts. And then working with the contractor to assess the damage and discuss matching materials for a unit owner. Matching materials, whenever there's a sink that overflows in that example, so it damaged the lower set of cabinets into the kitchen, and it also affected the hardwood floor. So you have the hardwood floors refinished, but where do you stop on that? Do you just stop in the kitchen? Actually, you can go, a lot of carriers will allow it to go until there's a break point, until you go into another room. But some unit owners may want, well, this is a good time for me to put hardwood floors in my bedroom now. So they'll put it, and that's fine if you want to do that. That's a great time to do it, but don't try to get the association's carrier to pick that up because it's not a covered event. And we talked about the lower level of cabinets in the kitchen. Well, they don't make those cabinets anymore, so they can't find a match for the upper cabinets. So guess what? That unit owner gets a whole new set of kitchen cabinets because of that overflowed sink that damaged the lower cabinets. And that's the reality of claims that we're seeing nowadays. That's another reason why we have seen deductibles go from $10,000 to $25,000 to $50,000, because these claims are getting very large, just simple water damage claims. Also, the unit owner signs all reconstruction contracts for any work done to the unit and all mitigation contracts. If the unit owner's unit is damaged, they sign the contract. If the association signs the contract, then the association could be responsible for any shortfalls of premium because the insurance company and the contractor did not agree on what the amount was. And I'll give you a quick example of a mediation example that we had on an account in Lake Oswego. And it was a kitchen fire, and it caused the sprinkler system to go off in the whole building. This ended up being over a $500,000 claim. And the mitigation for one of the units was over $45,000. But the carrier agreed on $30,000 because that was the normal, reasonable cost for mitigation. And this mitigation company was one of those unknown mitigation companies came in. So when these claims happen, people are very emotional and they're willing to make decisions fast. And I think some contractors are aware of that and they take advantage of it. So it's very, very, very important that you do have reputable mitigation companies in place, and that there's a process in place that's given to the unit owners before there's a claim. Because if they don't have this information, first thing they're going to do is go to Google and find someone. And that chances are is not going to be a vetted contractor. So let's go back over here to the association. That contact person collects damage estimates, determining again if it's going to exceed the association's deductible, and then also pays owners, contractors, and monies received by the association's carrier. Whenever there's a claim and the association's policy pays out, it pays it to the association because that's the named insured. It doesn't pay it to the individual unit owners. So the association gets that additional $50,000, and then it's up to this contact person, point of contact, to figure out which unit gets what. And they can look at the statement of loss. It'll have the units broken out on what the damage is. And that's how they can disperse those funds. One of the most important things when there is a claim is to keep the failed or broken part once they're going in there and ripping out, seeing what the cause of loss is. And when there is a water damage claim or any type of property damage claims, it's turned into the carrier. The carrier will send out an adjuster, and the adjuster very well could bring in an investigator or an inspector to see what the cause of loss is. And the reason why they do that, they want to make sure it's an insurable event. So if the cause of loss was a failed part, because a unit owner just had a dishwasher installed and it was installed incorrectly, we want to keep that part because the association's policy will still pay for that damage subject to the deductible. But with that failed part, they have the opportunity of subrogating after the appliance company that put in that dishwasher. So that's why it's very important to keep that failed part. And what's even more important is items not covered by the association's policy during a claim. Unit owners or tenants' personal property is not covered under the association's policy. This includes packing out their furniture, manipulating their furniture. As an example, we talked about the hardwood floors being damaged. Well, maybe the contractor has to get all of their furniture out, put it in storage, so they can refurnish all of the hardwood floor. That's not covered under the association's policy. It's covered under the HL6 policy. Loss of use. If a unit owner cannot stay in their unit because of a claim. I don't know if any of you have experienced a water damage claim, but if you get a sizable one, I mean, it's a total nightmare. Just the mitigation itself, you could have fans in your unit for at least a week. The heat's up high, it's noisy, you're supposed to keep it on 24 hours, and sometimes they're just tenting up certain parts of your unit. So you may have to live elsewhere, and that's even before the reconstruction begins.
126 degrees for 5 days in my house.
Yeah, and that's pretty miserable. I mean,
Yeah.
Tell me how you sleep at night under those conditions.
In a hotel.
Yeah. So anyhow, and it may take 6 months to get your unit up and going, especially if it's a fire claim. Fire claims are horrendous. I've seen those take up to 9 months or a year, depending on how big of a claim it is. So you as a unit owner has to live elsewhere. So you're going to have additional costs for that hotel, motel, or apartment, additional costs for eating out, maybe driving further to work. Any additional cost would be covered under loss of use that you would find under your H06 policy. And automobiles are not covered under the association's policy. Or your guests' automobiles, that is covered under your own policy if you have the right coverage. So if there is a car, say we'll even say in a carport or a garage, and it catches on fire, the garage, the association's policy is not going to respond to the automobile. That would be under your auto coverage if you have comprehensive and collision damage on that policy. Another thing is claims expense. Especially when you get sizable claims. Not all carriers will cover claims expense. In fact, most carriers don't. So the board has to hire someone to manage the claim. It could be a professional claims adjuster that manages claims. It could be the management company. Just to let you know, managers are extremely busy on the calmest days, but you throw in claims, especially this recent winter claim where some of these managers probably had 5, 6, 7, or 8 of their associations damaged. And 2, there's a cost for that. It's my understanding most management companies don't include that in the contract. It's an additional cost to manage claims. So the cost for that can also be submitted to the H06 carrier, and oftentimes that is divvied out by, if you got 4 or 5 units affected, their percentage of the claim, they would be responsible for the percentage of the claims fees. So if you have a unit that had 50% of the damage to their unit, then they would handle half of those claims fees. Any questions on that?
So Vern, I'll just add in there just for, I'm pretty sure everyone knows, but yes, CMI does charge additionally for any work that we do on insurance claims that would be at our hourly rate. And yeah, I'll just add that in there. There are a few companies that I know of that also assist with claims and other things. I've seen board members who will kind of assist with claims too. We can point you in the right direction of what needs to happen. A lot of it is just getting people together, getting the right people together to kind of make sure that everything's moving along.
Correct.
So I have a question.
Yes.
It's more clarifying. So with that charge from the CMI, that would be directed to the homeowner's insurance policy. Is that right?
It can
The
be,
whole-
right? So we always ask and see if they will cover the cost, and sometimes they do and sometimes they don't. It kind of just depends.
And
I
so
will say more often than not, it's not normally covered.
it's not covered. So
Nor, from what
normal.
I've seen.
Okay. And so then would that cost be put on the association?
Correct. Yes.
Oh, wow. Okay. And when you're referring to H06, I came in a little late, so I do apologize.
No worries.
Is that the homeowner's insurance? Is that what we're referring to?
Yes. Yeah,
Okay,
for
thank you.
condominiums, correct.
Yeah. Okay, thank you.
And one thing too, we talked about the insurance resolution. I have seen some resolutions also define who is responsible for that claims expense. And what I have seen is it's distributed to the affected unit owners. So sometimes the association may get tagged for it, or if you have it in your resolution, the unit owner. And if it's in the resolution and it's a contractual obligation, then there's probably a higher likelihood that the unit owner's carrier, the H06 policy, would pay for it than if it was not.
Vern, just a quick question on that, well, on that last slide.
Yes.
I see the HO6 mentioned a couple of times. I also see in the second bullet under unit owners, HO4. Is that supposed to be a 6, or is there such a thing as a 4?
No, it says if tenant is negligent, file a liability claim on their HO4. That is what we call a renter's insurance policy.
Okay, all right. Okay, so if you don't have any renters and you just have an HO6.
Right. All the owners would have an HO6, but if you own a unit and you're renting it out, then the owner would have a landlord policy, and then the tenant should have an HO4 policy if everything's set up correctly.
Yeah, okay, thank you.
Common claims mistakes. Number one is lack of contact person from the association. Again, that can be an absolute nightmare if there's not one person that's kind of directing, especially when you have multiple units affected. There needs to be one source where everything goes, in a point of contact, also communicating with everyone. Hiring multiple contractors. It's always best if you can get the mitigation and reconstruction contractor the same. Again, have that list of vetted contractors. We have a template too of the things to do in the event of a claim. And we have the name of, I think, 4 or 5 contractors that are very well known in the industry via CAI. They're members. They're very well known. Their names and numbers, just that kind of information, what unit owners should do and who to call in the event of a claim. Because when you're having water pouring into your unit, people get pretty hysterical about that and don't know what the first thing to do is. But hiring multiple contractors can be a bit challenging. And sometimes you'll get a unit owner that says, I want to hire my own contractor to do my unit. And we always try to see if one contractor can do it all, just because it makes the flow of paperwork easier. On the claims adjuster end, they're communicating with one person, but it is not required. A unit owner can use their own contractor. However, they need to understand that this is an insurance claim, and chances are your bid is going to be negotiated, and it can't just be repairing the unit $60,000. It has to be broken out, and I'm sure Carra has seen some of these breakouts. It's very specific to how much time they put into sheetrock, how much time they put into painting. It has to be that's how the insurance companies and contractors communicate on bids. And they also have to be licensed and bonded as well. Not using reputable contractors, that can be a big problem, especially during a claim. It's already frustrating. And then you find out the contractor is price gouging. The insurance company is not willing to pay these exorbitant fees. And we've seen this before. And this usually happens when the insurance company is not brought in early during the claim. It's after the claim is 2 or 3 months later. Sometimes the claim is completed. And then we get a call, oh, we've had a claim. Here's the bill from the contractor, if you can believe that. That gets very challenging for the carrier to really determine what the damage was. Lack of communication between the association and owners. Again, that's that contact person, point of contact. In the event of a claim, you need to manage the expectations for the unit owners. These things take time. It's not something that's going to be up and going in 2 weeks, especially when you have an event like we had in the middle of January, which is the worst property damage claim that we've had in over 30 years. So there was a big strain on claims adjusters and contractors, and there's still open claims from that event that we're still dealing with. It just takes a long time. The association signs contractor to prepare work or repair work and mitigation that isn't their property. So the association signs the contract with the contractor. That's a big problem, because if there is a problem between the insurance company and the contractor on what's to be paid, guess who's responsible for that? The association, opposed to the unit owner. Not tracking claims, financial components along the way. Again, there's a lot of moving parts going on here, receipts coming in, and managing all of that, and knowing where to send the money and who to send the money to. If this is not handled correctly, oftentimes contractors can be overpaid, which oftentimes the association ends up paying that overage. So it's very important to have that flow very well controlled. And then how to proactively avoid common claims mistake. The vetting the contractors, again, have a list of what to do when there's a claim, before there's a claim, letting unit owners know that. Have a list of those vetted contractors on there and their phone numbers. I mean, an example of some of those would be Kennedy is one that we see all the time, and there's a number. There's about 3 or 4 really good contractors out there that need to be on the list. So, in their contact information. Have an initial claims meeting that affects all the unit owners or tenants. So if there's 4 or 5 units affected, maybe have a Zoom meeting or a physical meeting that kind of outlines the process and what the expectation is. Get everybody on board to where it reduces the frustration of, when's my unit? Why is the adjuster not contacting me? Where's the contractor? So if we can manage those ahead of time, it just reduces a lot of stress in everybody's life. And then regular check-ins with the community manager or point person, whoever that point person is, making sure that they're contacting the unit owners, maybe weekly, on what's going on. So any questions on property claims before we get into liability claims?
For me, it sounds like communication is really about 75–80% of the whole thing, really.
That's right. And usually whenever we get a property manager calling saying, okay, this adjuster has not gotten back to us, or there's something going on, everything's coming to a grinding halt, and then we go and start poking around and find out. Oftentimes it's an adjuster waiting for something from the contact person,
Yeah.
or there's just lack of communication, that someone doesn't realize that someone's waiting for something, or that the contractor hasn't gotten something over. So had that adjuster just simply communicated and said, haven't forgotten about you, I'm still waiting for this, then that would have alleviated a lot of phone calls.
Vern?
Yeah.
Yeah. Hi, Ron Furman here. Hi. Just a question. How, should we be requiring HO6 policies?
If you can, I would. A lot of it depends. That's more of a legal question. Do your documents, and you're in Washington, so little different laws up there. But I would definitely check with your association's attorney, and if you can, then you definitely require that, because the other option is someone to pay out of pocket. And when someone's put in that position, then they're going to find every reason not to have to pay out of pocket, especially if you're looking at a $25,000 or $50,000 deductible.
Thank you.
So general liability claims. Let's go into that. So when we're talking, we said there's 4 claims that we deal with associations. The 2 big ones are property, that's the biggest. The next one is liability. Real similar to your auto policy. Your auto policy, property is going to cover damage to your automobile. Liability is going to cover damage to somebody else's property, or if you injure someone. The same applies with an association. So a liability policy basically protects the association in the event that they are sued or they are negligent for bodily injury or property damage. So we have two liability policies we're going to talk about. General liability, directors and officers. General liability deals with injury to individuals or property damage, somebody's property. A carrier, oftentimes I'll have a manager or board member call me up and say, someone got injured on our property, is this covered? And I'll say, yes, the carrier does have a duty to defend. So the carrier, when a lawsuit comes, the carrier has to defend the association. However, are they going to pay out on anything really depends on the information, whether they're negligent or not. Oftentimes you'll see someone will slip, trip, and fall, get injured, and then sue the association for $500,000 when they just skinned their elbow. Well, the carrier's clearly not going to pay out on that. They will pay for the medical bills. But how much they pay out after that really depends on the merits of the claim, whether the association was negligent. An example of negligence could be lifted sidewalks, tree root goes under, lifts up the sidewalk. And it's interesting because I have seen times to where associations have spray painted it orange to where people are aware of it. But on the flip side, that tells an attorney that the association was aware of it and they didn't do anything about it. So that can be a double-edged sword. So if the association was notified by somebody that I tripped on this, I didn't get injured, but you guys need to get it fixed, and then they didn't, then someone else trips on it and gets severely injured, that can be a big problem. So injuries in the common area, the limited common area, it could be the sidewalk around your association, like some of these associations down in the Pearl District that encompass the whole city block. They are responsible for, if someone trips on the sidewalk, they're going to come after the association. So keep that in mind. And let's talk about property damage claims. That can be an example, a tree. There's a tree. The association has a lot of trees on their property. They hire an arborist that comes out every year. The arborist says, you guys need to remove this tree. And the board is on a tight budget. They said, we'll deal with it next year. All of a sudden the tree falls on someone's car or the neighboring house. And then that would fall under property damage claims. Whereas the tree, if the association wasn't aware that the tree needed to come down, windstorm came and knocked it over, then that typically would not be a liability issue. It's what they call an act of God. So the association's policy would need to respond to that if it damaged someone else's property. Another thing is the association not maintaining the building. Not maintaining the roof. They have their roof inspected and the inspector says, you guys need to replace this roof. And the board, tight on money, as you know, a lot of associations are nowadays, decides to put that off. All of a sudden a heavy rain, the roof fails, damages a unit owner's personal property, the inside of their unit. The association's policy does not pay for the property damage to that. Because under property damage, I'm going back to property damage, there's exclusions in the policy that says if the resulting damage was caused by lack of maintenance, there is no coverage. Now, if the roof was damaged because of a windstorm, then the water coming in the carrier would respond to that. But because you didn't maintain it, water damage comes in, the association's policy is going to say, nope, here's that maintenance exclusion. And then the unit owner, carrier pays for the personal property, and then the unit owner and the carrier subrogates or sues the association. And under the liability is where you could find the coverage if the association was found negligent for not maintaining the building. And I'll tell you, that is one of the biggest nightmares for us to get coverage from other carriers when we see liability property damage claims like that, because that tells an underwriter that this is an association that's not maintaining their building. So here's just a couple of examples. Basically, I went over this. Someone slipped, tripped, and fell on a sidewalk, fracturing their ankle, and the injured party sued the association. The association's policy did pay the medical expense, and basically they could be found negligent, and they would have to pay anything, possibly anything else that's being asked, as long as it's not. And then here's one. A landowner adjacent to the association experienced a basement flood that damaged their property and personal belongings. After a storm, the landowner alleged that the storm runoff was due to the association's failure to maintain their drain basin. So there's another example of property damage, how a liability policy would respond. Any questions on liability before we go over to D&O? Directors and officers. This coverage is basically what we see on a good policy is it's going to pick up coverage for directors and officers, current directors and officers, any past board members. And also what's important is any volunteers or committee members as well. It's very important that they're pulled into this coverage as well, because the directors and officers could set up a committee, we'll say a landscape committee, to go around and make sure that people are doing what they're supposed to be doing. And a committee member tells someone you're not supposed to have flower pots on your steps going up. And this unit owner feels that they're being picked on and pressured on more than other unit owners because there's other owners out there that have pots on their steps, and then they sue this individual for discrimination. If you have a good D&O policy, it will pay for defense for that. So basically, it protects the board and the members for being personally liable, usually triggered by statutory violations, assessment disputes. These are typical claims we see. Breach of bylaws or governing documents. Again, those bylaws and governing documents have rules and regulations about how you're supposed to be doing things. And if the board is not doing that, then a unit owner, group of unit owners can file suit against the board. Here's an example. A unit owner is charged a late fee that they believe was wrongly imposed and has their attorneys serve a complaint to the board for breach of governing documents and fraud. So that's an example of D&O claims that we see. Common exclusions, discrimination. Now, I talked about that example of someone discriminating because you're requiring them to move the plant. A good D&O policy has defense for discrimination. It does not cover anything. If the association was found negligent for discrimination, anything that's awarded is not going to be covered under any insurance policy because that's a federal law that was broken. Injury or damage, that's what was covered under general liability. So if someone is injured or property is damaged, it's not covered under the directors and officers. It's covered under the general liability. Dishonest acts or breach of contract. And let me go over just a claim that we had. And this is just an example of how easy it can be to get pulled into a discrimination lawsuit. This is an association that was in a retirement area, like out in King City. So it's kind of the wood frame, woody walk-up type, multiple buildings, a lot of green area, 55 and older. And on one end of the association, there was this older guy. He was widowed. And he would play Lawrence Welk very loud all the time. He was hard of hearing. Everyone just knew that's the way John does it, you know. And on the other end, a lady had her grandson stay with them for a couple of weeks. and he liked to play rap music really loud. Well, the board told the grandson, went over there and said, "You can't play that music loud." So they filed a suit against the association, the board of directors, for discrimination, because you're telling one person they can't play the music loud, but you're allowing another person to play music loud. So that's an example of how easy you can get caught into one of these type of claims. Any questions on that? One thing with directors and officers is there are reporting requirements within the policies. So if something is happening, or you think something's happening, or you're getting a letter or an email of a threat, then you need to let your agent know, and we need to put the carrier on notice, letting them know what's going on. If this stuff goes on behind the scenes, if you take a long time to file a claim, you could eliminate coverage. So it's very important. The carrier wants to get in there right away and start building a case to defend the board. You know, is this really the case that's going on? It's the same thing with the liability as well. When there's an injury, someone's injured, you let us know as soon as possible so the carrier can get out there and take pictures. You know, was there really moss on the steps? Was the light really broken? Start building a case to help protect the association. So both of those claim activities need to be reported ASAP.
Vern?
Yes.
Hi, how about cyber coverage?
Yeah, we'll go into that on the next one.
Thank you.
Fidelity, crime and fidelity coverage. What happens when the association loses money? And this touches a little bit on cyber, but before we get into this, I will talk about cyber because there's different levels of cyber coverage, and it's becoming more prevalent. And there's one, social engineering, that we'll talk about here, but there's other types of cyber coverage as well. One would be an example of, we'll say that a property manager or board member had their laptop stolen, and on there had all of the unit owners' information, automatic deposit information, and all of that. And if you have some cyber coverage, cyber liability, then the carrier, if it's set up correctly, would pay for any monitoring for those unit owners, trying to get them back up and going. Another type of cyber coverage would obviously be any type of malware, stuff like that, or the association is being held hostage, and you're supposed to, you know, this person wants $10,000. We don't see it a lot right now with associations, because that computer is mostly the association, the management companies, any information there. But the social engineering, we have seen activity on that, and I'll go over that. So what crime coverage does, crime fidelity coverage, is it covers the association's reserve and operating account from embezzlement or computer fraud. There is a requirement, this is a lending requirement, that the association has to have at least full reserves and 3 months operating expense. That's the minimum amount of coverage that you can have for your fidelity coverage. And if the association is expecting a big chunk of money coming in, whether it's from a construction defect lawsuit or a construction loan, and money's being dumped into the account, let your agent know. We can readjust that amount. It's not that expensive, and I'll tell you why in a bit when we'll go over a claims experience we had. The coverage includes employee theft, includes board members and community members. A good fidelity coverage has to extend to whoever manages the money. I've seen some policies where it's just employee dishonesty, that it covers the employee only of an association. Well, most associations don't have employees, and if they do, they don't cover the funds. So it's very important that the coverage does extend to board members and community managers, or a bookkeeper if you use a bookkeeper. And then I'm going to talk about computer fraud. It does include forgery or alterations, disappearance, and destruction. That there's not an exposure for association for that, or money orders or counterfeit paper currency, but you do have that coverage. But computer fraud, an example of that might be is a third party getting access to the funds via computer. One might be that, and I'm not saying anything about CMI because they are probably one of the most diligent in managing funds, but you have a management company to where the property manager likes to keep the password of their computer on their desk, and the cleaning crew comes in at night, gets access to it, and ends up transferring funds. That would be computer fraud wire transfer. That's an example of that. In social engineering, that's another one, and we have an example down here. But let me explain a couple of claims that we've had. I've been doing this for 22 years, and when it comes to crime or fidelity claims, I would think that I've had 3 or 4 of them. In the last 3 years, I have had 5 social engineering claims. So let me tell you about one of the claims we had with social engineering. This was a management company back in 2011 that managed a lot of associations. They had 30 associations here. Back then, that was considered a middle-sized management company. Anyhow, they decided that they needed the money more than all of their associations that they managed. So they set up this elaborate scheme of setting up fake bank statements. It was a Ponzi scheme. And anyhow, it all collapsed, and they had 30 associations and took the money out of all of the associations. We insured 15 of them. Some of the others that were insured by other companies had no coverage at all because they had employee dishonesty. It didn't extend to the management company. So there was no coverage for the money that was taken. Most of our associations were paid out in full. There were a couple that were not paid the full amount because at renewal, we had a $50,000 limit. They had increased their amount by collecting reserves, say to $75,000. The policy only paid out $50,000. We had one account that had $500,000 deposited into their account because of a construction issue, and they were paid $500,000. We added it onto the policy 3 days later, it was stolen. So that was covered, that amount was covered. But had they not told us about it and had us add the coverage, there would be no coverage for that. These claims are extremely frustrating. They take a long time to adjust. They have to get a forensic accountant out to determine, how much money was really taken. I mean, they take up to 6 to 9 months. We had, and this is kind of odd, we had one association that had all of their money taken and they couldn't pay for their insurance. And so the management company that took all their money loaned them the money to pay for their insurance. But you can see when all the money is taken, what a bind that can be put the association in. I've never had one that big. Other than that, there's been maybe a board member that's taken some money, or a self-managed association that hired their own property manager that kind of embezzled money over time. But we don't see those claims a lot. But the social engineering we have seen, like I said, in the last I think 3 to 4 years, I've seen 5 claims. And I'll go over that example down here. It says the treasurer of an association receives an email that purports to be from a vendor. So it's from a vendor requesting they transfer funds from the trust account for work that is to be performed. The treasurer transfers the funds as requested. Later, it discovers a thief was impersonating the vendor and the funds were transferred to the thief's account. So you have to have social engineering, because under the typical crime fidelity policy, if you willingly give money to somebody, that's not covered. So you have this social engineering coverage, and not all policies carry it. Not all carriers provide it. It's getting easier to get larger amounts. Typically what we're seeing now is the max you can get is $100,000. But there are policies now, true cyber policies, that incorporate social engineering that you can get $400,000 or $500,000. But we had one to where one management company sent out funds to their, what it was is they had a billing company that all the funds went to. And someone impersonated the management company and said, we're going to shift these funds, instead of going to these accounts, go to this account. The billing company did it. And there were actually a total of maybe 4 or 5 associations. We insured 3 of them that had those funds taken. And it wasn't a small amount. One, I think the largest was $150,000. The management company did have a policy. And we also had the coverage for our 3 associations. Our association paid the money out. The coverage we had on the association paid the money out quickly. The property management policy took about 6 months to respond, because it's not their client's money. It's not the insurance client's money, it's somebody's third-party money. So it takes a lot more time to get that. So once they did decide that this is a covered event, after there's fights with attorneys, blah, 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 then they did end up paying back our carriers for what was paid out. But that's an idea of social engineering. And if you have $100,000 limit and $200,000 is taken out, then you're short $100,000. Very important when someone's doing wire transferring that a phone call is made and that information is confirmed. Any questions on that? So just some final notes, so you guys can get on with your evening. The best way to handle claims is to prevent them from happening, period. As any of you that have experienced a claim, it's just a nightmare, even if it goes smoothly. The unit owner is displaced, has to go somewhere else. It takes a while. There's always a frustrating level of making sure everything's done on time. The best thing to do is to prevent the claim. And preventative measures are, number 1, increasing the deductible. That's not preventing the claim, it's shifting the responsibility on the unit owner, but the association's policy doesn't respond. Keeping up with regular preventative maintenance on the building. Upgrade plumbing, electrical, and heating and roofs, especially I'll tell you right now, any association that was built before 1990, carriers are looking very hard at what improvements. 2 years ago, it was anything before 1980. Now it's 1990. Carriers do not want to insure older wood frame buildings or older buildings. They look at them very hard. They want to make sure that the plumbing is updated, the electrical has been inspected, the heating, the roofs are well maintained. They look really close at that. And regular communication with owners on what they can help to do their part. There are maintenance requirements for owners. Oftentimes owners think, well, I live in a condo, the maintenance is on the association. I don't need to maintain anything. That's not true. They need to maintain the inside of their unit. We always recommend a maintenance matrix that clearly outlines what the association is maintaining and what the unit owner needs to maintain. Examples of what they need to maintain is the fixtures inside of their units, their appliances, the fixtures around their toilets, the fixtures inside of the tank. The hot water dispenser is a culprit that we've seen. We had a claim 2 years ago one of those leaked, affecting 3 units, $450,000 in damage on that hot water dispenser. We're starting to see those be a problem, especially in the high-rise condominiums. So make sure that that there's a well maintenance program in place. One of the things we're seeing from underwriters when we negotiate terms at renewal, the number one question we're seeing is, what is the board doing to prevent water damage claims? And by saying nothing, that is not a good answer. So keep that in mind. Another thing is developing and maintaining a strong working relationship with your insurance advisor. Make sure you understand what coverage you have and what unit owners need to do as far as maintenance. Do a town hall meeting with the unit owners to make sure, have your agent sponsor that, educating the unit owners on what type of coverage they need to have. Association coverage is very confusing. It is even for veteran insurance agents, because in an association with 40 units, you got 41 policies in place when there's a loss. And there's deductibles involved. It gets very complex. So make sure your agent's in there to help outline how that works, and also engage in risk management and claims trends that are going up. And another thing on a closing note that I want to talk about is the state of the marketplace. I'm sure most of you have experienced on your renewal the increase in pricing, restructuring of deductibles. I've been doing this, as was mentioned, for 39 years and associations for 22 years. I have never seen it this challenging for coverage, finding coverage. You will see on renewals, we give the managers, there used to only be 5 questions on renewals. Now there's 20 questions. Underwriters are just scrutinizing everything on renewal. We need to get additional information, copies of reserve studies. Is the association keeping up on that, maintaining? So much information is needed. Carriers are exiting the market. I'm not here to try to scare you at all. I'm just trying to manage your expectations. We are getting some carriers coming back in. We are starting to see a little bit of the leveling off, meaning that we're not seeing 20 or 30% increases, that we may only see 5 or 10% increases on clean accounts that haven't had claims or staying with the same carriers. But as you all know, we just experienced one of the worst property damage events in 30 years. So that's going to wreak havoc on these renewals coming up. So I'm just trying to manage the expectations on everyone on what's coming up around the corner. Hopefully it does start leveling off, because it's just getting very challenging. And I'm not whining. It's challenging for me to have to give bad news to boards all the time. Any questions on that?
I have one.
Yeah.
So on that last comment of, with the situations that have been going on and prices will increase, is each policy looked at as, you had mentioned something about, being clean, or not a lot of claims have been made? Or is that across the board and everybody is increased by 5%, 10%? How is that done?
I would say that if you have what we're going to say is the preferred account in the eyes of underwriting, and you haven't had any claims, well-funded reserve study, low rentals, newer building, I would still say you're going to experience a 10 to 15% rate increase.
Oh my God. And what do you consider a newer building?
Anything built 2000 and newer.
Okay. Okay, thank you.
And a lot of that has, and let me throw a caveat in there. A lot of it depends on if you have earthquake coverage, because that's continues to drive some of the increased cost, is the reinsurance. But these carriers, I'll just tell you as an example, one of the carriers that we use, quite a bit. Here in this last storm, experienced $15 million in claims. In the Pacific Northwest, they bring in $6 million in premium. That was just one claim event. That doesn't count the rest of the claims they've had year round. So that gives you an idea of what some of these carriers are dealing with.
Okay. Thank you very much. This has been enjoyable.
Thanks, Carol. So Vern, we had a question in the chat that we want to make sure got answered. It was, if a homeowner brings in an engineer to assist in a claim, who would pay that engineer?
If it's above and beyond the scope of what's typically covered, the homeowner would need to. Like an engineer, like a claims adjuster, a personal, because typically what happens is they would bring in a personal claims adjuster. Unless they're bringing in an engineer because they're saying there's structural damage. And the claims adjuster is claiming there's no structural damage, but the engineer is saying, yes, there is, then they bring that in. If that was their case, there could be a chance that the association's policy could pay for it if everything exceeds the deductible. It really depends on the context of what's going on with this engineer.
Thanks.
And why they're there and what they're looking for.
Barry?
Hi, Vern. This is Barry Taylor Brill. I had a question about, whether or not boards are adopting insurance coverage and claims handling policies and procedures. You mentioned before insurance resolution. My concern always is, with board turnover, et cetera, a lot of knowledge and experience can walk out the door, and you're left to reinvent the wheel in terms of the education of the board, et cetera, including, calls like this to help everybody out. But do you see that people are formalizing that and adopting anything that can be left as a legacy for each board, that they're actually adopting policy and procedures around some of these issues so they have a roadmap?
Yeah, the resolution is key for that. And it's something that would be approved by the association's attorney. And we see some pretty extravagant resolutions that go through some pretty clear detail. And that is basically a roadmap of what to do in the event of a claim.
I would also add that CMI did go through a lot of our clients to make sure that there were collection resolutions in place. There are some that may need to be updated, so it isn't something maybe to keep your eye on. We do send it out every year as part of our budget packet with a reminder to review the resolution kind of for every owner too.
Thank you very much.
Hey, Vern.
Yes.
Yeah, this is Lee Galloway. Thanks a lot for coming up and seeing our association here, about 2 months ago. As you know, we had extensive claims due to the winter storm damage. And right now we're almost finalized. We're getting new windows put in this next week. And so, but we did, according to what you were talking about earlier, I think I did everything correctly. So, the adjuster and ID construction, they all seem to agree on the prices. So anyhow, I just want to tell you, thank you again for coming out and meeting with our group. And it was an interesting being on this conversation tonight, because I did get a whole nother page of notes.
Good. I'm glad it worked out okay for you guys. Any other questions? Well, again, I want to thank you all for attending this. Insurance is never an exciting topic, especially on a sunny evening. And if there's anything else that comes up, feel free to, you can email me direct or via Carra, and then I will respond. And thanks again for your support and being active board members. This is very, very, very important stuff.
Thank you very much, Vern.
Thank you, Vern.
Thank you all.
You bet.
Thanks, Carra. Thanks, Vern.
Thanks, Vern. Thanks, Carra.
Have a good night.
Have a great night, everyone.